What's going on, everybody, and welcome to the video. In this one, what we are talking about is how to build a dividend stock portfolio, step-by-step guide. We're going to go over my dividend stock portfolio, helping you build yours, why I chose the stocks I chose them, how I chose these stocks, and why I even choose dividend investing and dividend growth investing in general, okay? So before I do go any further within this video, all I ask that if you enjoy it, you make sure you give this video a thumbs up and that you subscribe. You turn on post notifications for videos coming out every other day, trying to provide as much value as I can, helping everybody make as much passive income with dividend stocks. But before I talk anymore, let's get into this video. So what we're looking at is currently my dividend portfolio on M1 Finance. So what we're seeing right here is you can actually get this portfolio in the description below. In the comments, you can just get a link. It's 100% free. You can go look at my holdings. You can see right here that we have tech cloud computing targets, income fund, which is just some high dividend yield ETFs, and some dividend growth ETFs, real estate, banking and fintech, consumer and stores, and restaurants and food. Now, if you just want to go look into one of these, we can look on, for example, let's look on the income fund. These are some more higher yielding things. We can see that this little pie itself has a 5.82% dividend yield and an expense ratio of 0.21%, leaving us with a net yield of about 5.61%, which is very, very high. Some of my targets right here are JEPI, SCHD, SPYD, XYLD, SPHD, and QYLD. You can go check these out. I don't want to talk too much about this. You came here to go see how to build a different portfolio, and let's go over that. So first off, why dividend stocks? Well, if you actually look at the total market returns of the past 50, 40 years, dividends are a large percent of the total stock market returns. Ever since literally 1980, 75% of the S&P 500 returns have came from dividends. So that's massive. Check this out. Going back to 1970, 84% of the total return of the S&P 500 index can be attributed to reinvested dividends and the power of compounding. Just look at this example right here. You invested $10,000 with no dividends, you would have gotten 627 grand, which is still a lot of money. But if you would have used your dividends and reinvested those, you would have gotten 3.84 million, pretty much $3.85 million, which is incredible stuff. Now, second off, dividend paying stocks perform far better than the market in the long term. Check this out. Dividend paying stocks have outperformed over time. Here are your dividend growers, and these are the companies out there that, let's say for example, you invest in a company that pays a 1% dividend yield. Well, this year they grow their dividend and now they pay a 1.5% dividend yield. And those are your dividend growers. Now your dividend payers, these are just companies that pay dividend yields on average, they at least pay their dividend to their shareholders. They're performing 9.10% on average per year since 1986. Now your S&P 500 and TSX composite index is only performing at 6.1% every single year. Companies that don't pay dividends, you got 1.2% average return, and dividend cutters is 2.9% return. So that is one thing to keep in mind. These dividend companies are very more sustainable, have more value, and have more upside potential long term than most of these growth stocks that you will be seeing. Third, it's consistent passive income. Okay, literally you buy this stock on a set basis. It could be monthly, quarterly, semi-annually. Who knows how often they're going to pay. Usually it is on a quarterly basis. Some of them do pay monthly. You're going to be collecting these mini checks, and you just keep collecting them. And if you reinvest your dividends, which I highly recommend, I don't suggest that you just take out your dividends and you buy whatever. You technically could leave your dividend and be like, okay, I want to go to Chick-fil-A or something. But no, reinvest those dividends, because in the future it'll pay off so much more. And then fourth, it is way better against stock market crashes and bear markets. Literally, I saw a study, it was if you invested in 1998, right before the dot-com bubble, and you put $1,000 in, and you did not do any dividends, you just invested in growth companies like the S&P 500, until 2010, you would have been down 10%. But if you would have had your dividends reinvested and made all this dividend income, you would have actually had a return of 18%, which is way better than negative 10%. And fifth, the dividend snowball effect. What this is, let's say, for example, you start your portfolio today. You put in $1,000. Well, you slowly add money. You put in $100 per month. Next year, your portfolio is worth technically $2,200 in principal that you've put in. Let's say it increased in 10%, so it's up a little bit more. What happens now? Well, now you're getting paid more dividends. And the more you pay, the more you buy these stocks, the more they're going to pay you. And over time, it's just going to keep adding up. And then it's going to keep paying you more. And you're going to reinvest those dividends and it'll pay you more the next time. And it adds up and it adds up. And the compounding is absolutely insane with this stuff. Now, just to give you an example of dividend yield so you can know this before we go into how to choose your dividend stocks, is this is the way the dividend yield works. So let's say, for example, we have a stock right here with a 3.50% dividend yield. You invest $100 into this company in the stock. So you get $100 investment times a 3.5% yield. That means on an annual basis, you're going to be receiving $3.50. For example, if it was a 1.25% dividend yield, for every $100 you put in, you'd be getting $1.25. So that is kind of how the dividend yield pretty much works. But let's talk about how to build a dividend stock portfolio. So my first tip is invest rather than spending. Now I know everybody has expenses. I'm not saying to cut out all your expenses, but what I will say is cut out the unnecessary expenses. Everybody says that, and it's actually insanely incredible. Just adding an extra $50 a month into your portfolio from unnecessary expenses that you don't need can make a massive difference in the long term. Now, second off, don't be a yield chaser. Please don't go find a stock that has a 15% dividend yield and you go buy it because the dividend yield is so high. Most likely that payout ratio is going to be above 100%, meaning that they are taking on debt and everything they can to pay that dividend, which is not sustainable, and you're going to be screwed in the long term because if they're doing that, it's most likely not a solid, valuable company, and they're just kind of screwing themselves and putting themselves in a hole that they're someday not going to be able to dig themselves out of. And make sure the dividend stocks have a good payout ratio. So for most stocks, I like to aim for 60% or lower for safety. Now what a payout ratio is that is the amount of net income that they pay out to their shareholders. So for example, we are looking at Microsoft Corporation right now. We can see it says their payout ratio is 27.09%. I'm on Seeking Alpha, by the way. You can use it. It's free, really good stuff. But what we're seeing right here is their payout ratio is 27.09%. So what that implies is 27.09% of all of Microsoft's earnings, net income, is paid out back to shareholders. The rest of that money is reinvested back in the company, whatever they might do with it, What we can see right here is they have a semi-low dividend yield of 0.74%, but Microsoft is still one of my top holdings because I believe in the company, the growth, the dividend yield. I believe that this company, in the long term, my yield on cost will be far better than this low dividend yield. Now looking onto some more stuff, some exceptions for up to 80%. Like a company right here, like this is Altra Group. They currently trade at $45 a share. We'll see that they have a dividend growth record of 52 years, meaning they've been paying out these dividends and increasing them for 52 years. They have a whopping dividend yield of 8.01% and a payout ratio of 77.31%. But this company is not necessarily as innovative as a tech company like Microsoft. They're going to be paying out more to their shareholders and using the rest of that money to keep the company flowing and do all different things like that. Another example is a company like Toronto Dominion Bank. What we're seeing right here is they have a nice dividend yield of 3.41% and a very low payout ratio of 39.95%. So you want to make sure that these payout ratios are low. The lower they are, relatively speaking, that means the more sustainable that they are and the more they can keep paying these dividends and increasing these dividends to their shareholders. Now, looking at some more stuff, REITs, a real estate investment trust, whenever you invest in those usually will have higher payout ratios because they're required to. Like you can see right here, to qualify as a REIT, the trust must distribute at least 90% of its taxable income to shareholders. So their payout ratios are going to be a lot higher. For example, Realty Income is one of my favorite REITs. They have a payout ratio of 81.61%, but that's okay. REITs with 80% is pretty good, and I think that is very good stuff. With a dividend yield of 3.92% also, it's a very good company in my personal opinion. Now, third, invest in companies that have a bright future. When you invest in a dividend stock, make sure that the company will grow in total value and not just the dividends. Now, what I mean is, take for example, AT&T stock. Okay, let's literally look up AT&T stock right now. I personally do not like AT&T stock. I know that a lot of people do, but over the past year, it's down 8.3%, and over the past 5 years, it's down 31%. Now, a lot of people do invest in this for the dividend yield because it has a nice yield of 8.26%. However, I don't like this because I would rather have a company that's increasing in share price appreciation, giving me capital gains, while the dividend is increasing, because while the dividend share price increases, while the share price increases, the dividend yield will likely increase with that, and it shows that it's a solid company that's making you gains in two different ways, not losses and gains that come down to a net loss. So please make sure you're investing in companies that will grow in total value and not just the dividends. Fourth, invest in what you know and understand. What that means is invest in companies that you understand, like you understand exactly how this company makes money. Don't invest in something because a YouTuber or a TikToker said, buy this stock simply because they do this and this and this and this. For example, like you invest in a really complicated software company. You don't understand how they're making money. You just went off of this and now you're kind of sitting there like the stock went down and you don't know what to do. Like for example, I invested in a company called Voyager Digital, and I invested in them a long time ago. And this company, their share price just kept falling, but I understood how the company operates. And if I wouldn't have understood what the company does, I would have sold. But like literally 2 weeks ago, maybe even a week ago, the stock went up like 40% in a single day. And it's because the company provided incredible value to shareholders, and that is the power of understanding what you're investing in. Now, fifth, aim for any dividend yield as long as it's sustainable. Anything below 1% is pretty low, but it's still a dividend yield. Make sure it's sustainable. 3% is pretty good, and anything above 5% is pretty high. Now, only buy companies that you have a good gut feeling about. Make sure that you truly believe in the future of the company and their dividends. Like, don't invest in a company if you're iffy about it. Like, literally be like, hey, I want to buy this company. I want to invest in this company. I don't care what other people say. I like it. That's whenever you should be buying these companies, okay? Now, seventh, make sure the company has increasing revenue, net income, and free cash flows. Now, what we'll see right here is I'll just show you what this means, what we're looking right now, and you also want to make sure they have a good balance sheet. Total asset compared to total liabilities. This is on Microsoft. They have more in assets compared to liabilities. I'm using Yahoo Finance to look at this stuff. The income statement, total revenue, increasing year over year. You can see that number keeps getting bigger. The net income keeps getting bigger as well. You really want to make sure they are increasing net income and increasing free cash flows, because what does that mean? That means they have more cash, more money to pay out to shareholders, which are you and me. And that is how to build a dividend stock portfolio, simply explained. And that is what I have for you in this video. So if you did enjoy it, make sure to subscribe and turn on those post notifications for videos coming out every other day. I always like to see what you guys are doing, what you guys are thinking. So make sure to leave a comment down below what you think about this video. I always like to see your guys' opinions, and it really helps out the algorithm, helps me get this video out to as many people as possible. Again, thank you so much. Check out the links in the description below for some free stocks and free money. Even you can get on my portfolio. But again, thank you, and I'll see you at the next video.